Hello everybody, welcome to today's video. In today's video, we're going to go over Elliott wave counts. What are Elliott wave counts? How to count these counts in the market, and how you can actually correlate them with the Fibonacci so that they can actually be more effective in the market. So if that sounds interesting to you, please do stick with us until the end. Don't forget to like, share, subscribe, and turn on the bell notification so that you'll be notified whenever we release content like this in the future. Now, in front of us is the DXY. We're going to start off with theoretics, obviously. What are Elliott wave counts? Elliott wave counts are pattern counts that are based off waves, right? So there's this guy back in the day, I can't recall the year, but he discovered that in the markets, prices, we all understand prices move in waves, right? In the market, prices move in waves. But this guy called Elliot discovered that these waves are not random. They actually have a pattern to them. And if you discover how to actually count these waves, you can actually predict after which wave comes what wave. And hence, he created the system called the Elliott wave count. So with Elliott wave counts, he believed that there's always going to be an impulse wave, right? An impulse wave is the wave that actually goes in the direction of the trend. And then after an impulse wave, there is a correction wave, right? A correction wave goes counter trend. And this is what we call retracement. This is what we call correction. But then it's a small wave that goes against the trend. And then after this, another wave comes out from here and continues with the trend, right? And keeps on pushing higher and higher and higher. So he believed that these is the patterns in which all waves are formed. Impulse wave, correction, and then continuation. Impulse wave, retracement, then continuation. It doesn't matter. Unless the trend is being broken, then it will actually be the opposite of this, right? Now, he discovered this and decided to, form a pattern with it. So what he discovered was this. This is what he discovered. First, like the impulse wave always moves with 3 strong impulses, right? He discovered that the impulse wave always moves with strong 3 impulse pushes, and then after this they come back to retrace with 3 retracement waves, right? And these impulse waves actually have characteristics which we're going to talk about in a while, in a jiff, but he actually named them. So it starts at 0, and then there's a first wave, there's a second wave, which is the retracement. There's a third wave, which is the strongest and longest wave of the impulse wave. And then there's the fourth wave, which is the retracement. And then there's the fifth wave, which is the last impulse wave, right? Now, after the fifth wave, that's the retracement. The retracements, you get the 1, 2, 3s. You get the ABC, excuse me. You get the 0, you get the A, you get the B, which is the retracement of the impulse wave, and then you get a C. So you get the A, B, C, right? So it's 1, 2, 3, 4, 5, and then A, B, C. After C, you get another crazy impulse wave here. You start again the trend, right? 1, 2, 3, 4, 5, let's say. So he believed that the market always moves in this way. Obviously, there are some variables that change along the way because the market isn't always constant, but basically, in the most part, the market always moves this way. So that means here again, the waves will start counting 0, we'll start 1, we'll go 2, we'll go 3, we'll go 4, we'll go 5, right? And here's the thing that he realized, like it's waves within waves. I'm not sure if that makes sense. So for instance, do you see here, we have this 1, 2, 3, 4, 5, and then we get the ABC, right? After the ABC, we start again 1, 2, 3, 4, 5, right? Do you see this 1, 2, 3, 4, 5? He says it's also a wave, or it's an impulse wave that's in a bigger wave. So you see all of this. Let me put it this way. So do you see all of this? Where's that? Let me put it in that ellipse. So do you see all of this? 1, 2, 3, 4, 5. All of this is a wave 1 of one wave. And then this one, this ABC, it's wave 2 of a bigger wave. So that means if you zoom out, this will be wave 1. All of this will be wave 1. And then this will be wave 2. And then continuing up here, this is wave 3. And so on and so forth. That means we'll get wave 4 somewhere here and then wave 5 somewhere up there, right? So that's what he believes. Like it's always waves within waves within waves. So that means here in this wave 1, 2, 3, 4, 5, all of this is just wave 1 of a bigger wave. And then this ABC, it's just wave 2 of a bigger wave, right? So let's assume all of this 1, 2, 3, 4, 5 was a 1 hour trend. And then this wave 1 was a daily trend, if that makes sense. And then this wave 2 was also from a daily trend, but this ABC was from a 1 hour trend. If I put it that way, I think it will actually make more sense, right? So it's always waves within waves within waves. Now, more about that in the future, but today I just want to cover about their characteristics. What are some of the characteristics of waves that are actually important that you need to understand that will actually make your trading a little bit better, you know? Some of these characteristics are that you need to understand what's the strongest wave, what's the best wave to catch a trend, and after what wave you need to be out of a trade. Because obviously, if you know those, it will actually make your trade much more easier, right? Now, in your trading, you should always be looking to catch this wave 3 here. This wave 3 is the wave that you need to always be looking to catch, because wave 3 is the strongest wave. And wave 3 comes from after the change of trend. So do you see this wave 1? It just doesn't start out of the blue. It's after a trend has ended. So let's say here prices were in a downtrend, and then prices came here. And then after here, prices started, they broke this structure, gave us a retest. So after this, you need to understand like, okay, here the trend has changed. The trend has changed. And we are actually looking to continue pushing higher, right? We are looking to push higher. That means this is wave 1, here is wave 2. We are going to catch wave 3. So wave 3 is the second strong impulse wave after the trend has changed. This is the wave that you always need to catch because this is the strongest wave, meaning that this wave doesn't have a lot of retracement. This wave doesn't have a lot of consolidations. This wave is the strongest, meaning it always goes the farthest, meaning it will give you much more profits than any other wave that you need to catch. So wave 3 is the wave that you always need to be looking out and you need to be catching, as it is the strongest wave, right? And that's how you can actually catch it. In the market, you shouldn't be looking to take a trade after wave 5. Yes, prices may have been pushing up for a while, but prices move in waves, as I just told you. So that means prices will be exhausted at wave 5, and they'll need to retrace or to correct a little bit in order to gain some momentum. So after wave 5, you shouldn't really be looking to take any trades. You should just be waiting for retracements. After retracements, that's when you should be looking to take, the continuation of the move. Another characteristic that you need to actually understand is that the difference between wave 2 and wave 4. Because some people like to trade counter trend waves, excuse me. So in case you are trading wave 2, let's put it this way. So prices move this way. prices, once they start this way, once they reach here, let's say, okay, that's wave 2, wave 3, the longest, and then wave 4 does something like that, maybe. And then we got wave 5, right? Or it may actually do something like this. I'll explain in a little bit. These are some of the characteristics that you need to understand in order for you to actually help yourself get better trades in the market. Okay, so wave 2 and wave 4 are actually opposites, right? They actually go in, they're actually opposite. Like if wave 2 consolidated, wave 4 will be steep. If wave 4 is, if wave 2 was steep, because wave 2 is the first one to be formed, wave 4 will consolidate, right? So for instance, you took a trade here, pop, you saw wave 2 being formed, wave 2 was steep. You understand, like, okay, wave 4 here, it will be some sort of a consolidation, so I shouldn't be trading this. But if wave 2 started off by consolidation and you want to trade this counter trend wave, that means wave 4, you understand it to be a steep wave. That means it will just be very fast. You'll just book your profit and you'll be out of the trade. So understanding these two will actually help you if you're going to be taking the trade at wave 4, or you're not going to be taking the trade, because by understanding the characteristic of wave 2 here. Does that make sense? Let me know in the comments below if that makes sense. If that makes sense, all good, thumbs up, we good. Another thing is that these waves also have Fibonacci characteristics to them, right? So wave 2 always resonates or always retraces to 0.5 or 0.618 of the first wave. So that means it will retrace to about 0.6 or 0.5 of the first wave. That's when wave 2 will retrace to. So if you're looking for entries for wave 3, you should be looking for entries at 0.5 or 0.618. And then if you're looking for entries to capture wave 5, you need to be looking for entries at 0.3. Because with wave 3, you need to understand, like, this is the strongest wave. This has the strongest momentum. That means the retracement isn't always going to be very steep. It's just going to be shallow because the momentum is still strong, right? So here, wave 3 obviously will retrace to about 0.38 of the Fibonacci key level. And then after that, that's when prices take off to about wave 5. And wave 5 is most of the times the distance. If wave 3 is the longest wave, keep that in mind. Wave 1, most of the time, will be the same distance as wave 5, right? So once you get your 0.38 here, you can look to take a trade to capture this whole wave 5 by measuring the distance or the number of pips of wave 1, and you'll actually get your approximation of wave 5 and where you need to be placing your take profits. So yeah, those are just the basics of how to capture these waves and the Fibonacci correlations to it. Okay, so for instance, let's take a look example here. First example here, you can obviously see the trend here was actually a bearish trend, and then we started off breaking above this structure here on the DXY, breaking above this structure, creating a higher high. So that means the trend has changed. We are looking at DXY right now. So this will be 0, this will be 1, this will be 2. Obviously, wave 3, always the longest wave. And then we got wave 4. And now we are looking to take wave 5. But where will wave 5 actually be ending? We measure the distance of wave 1, and then we place it at where wave 5 bounced to. And then we look if there's a Fibonacci, or if there's a market structure at where wave 5 needs to be ending. And we can obviously see it's correlating with this height up here. So if we look to take a trade on DXY right now, our take profit should be placed somewhere here, because after wave 5, there's a very high possibility that prices might retrace to look for more buying momentum down here. rather than continuing with this solid trend. So that's just a highlight on how you can actually count waves while incorporating them to your free price action or to your everyday market structure. If you found value in this video, guys, please do like, share, subscribe, and share with a few friends that you believe will find value in it. Till next time, guys, I appreciate you all. Let me know what you'd like me to talk about in the next video in the comments below. With that being said, turn on that bell notification, subscribe. I'll see you then. Peace. We out here.